just so we can keep track where we're at. 3-33. So we have bad debt. And so bad debt are basically when you lend money out on credit and then these people don't pay you back. So what you do is you put an account aside called allowance for doubtful accounts. So in the event that these people don't pay you back, you've already factored that in and you're not taking a big hit. So let's read what that means. We set up an account on the balance sheet called allowance for doubtful accounts, which is then subtracted from the account receivable on the balance sheet like this. So here's the current asset, account receivable. That's money that you're anticipating. You did the job. They're supposed to send a check in the mail. You're waiting for that check in the mail, but you still record it, right? And then in this case, they took out 2,000, right? And that's allowance for doubtful accounts. And now you have a net account receivable of 36,000. So, and it states that the allowance for the doubtful account has a credit balance. That's all you really need to know there, right? And so we go on to depreciation. This section is heavily quizzed on. I've seen so many questions on depreciation, and I'll be sure to point out the different methods that I see so that way you can be prepared, all right? So depreciation. Equipment deteriorate during the use and therefore loses value each year. Part of the cost of the equipment should be allocated as an expense to each year's operating, benefiting from its use. The allocation of cost of a piece of equipment over its useful life is called depreciation, right? Cars depreciate, trucks depreciate, materials depreciate. And then further down, you want to know that rather than simply reducing the balance of the truck, construction equipment and building accounts on the balance sheet, more information is provided if we create an account called accumulated depreciation for each. 3-34, right? Good job, guys. Keep it through, stick it through. I promise you, all of this is important. You want to know all this stuff because you're going to see it on the quiz, man. I saw the quiz. I took it. I took the exam. I passed the exam. And I'm trying to help you do the same thing. So write it through, bro. Make up your mind right now that this is the time for you to concentrate as hard as possible. 3-34, right? We're on depreciation and taxes. Deep down here, we have the maker's method. You're going to see this on a test. I can promise you that, which stands for Modified Accelerated Cost Recovery System. It says residential rental properties depreciated over the years of 27.5, right? And then we have under the maker's system, all personal property, 3, 5, 7, and 10-year category is depreciated using the old 200% declining method. And the Builder's Guide to Accounting, they call that a double declining method, which is the same thing, all right? And then right on here at the very top right, we don't really need to know any of that, to be quite honest with you, I promise you. All right, so let's skip over to 3-36. Here's the most important part. The opposite version of depreciation is amortization. We're on 3-36. Amortization is essentially another way of saying depreciation, except that amortization applies that the cost of an item is written off in equal amounts over the period of a year or months. Example, mortgage. This is really the same as straight line depreciation. And I took the time to put like a little circle around this because they'll try to trick you with the definitions of amortization and depreciation. And they're kind of the same thing, but they have different end goals, right? And they apply to different assets. So depreciation, when referring to write off on tangible assets, you depreciate a tangible asset. And a tangible asset would be a car, a drill, right? You can depreciate the usage. Amortization refers to the intangible asset, like a mortgage. You're making your payments every month and you're knocking down a certain part of the mortgage until it's done. So that's intangible because you can't really see it, but it applies to an actual tangible structure, which is the house. But long story short, you just want to remember, depreciate the tangible, amortize the intangible. Literally all you want to know. 3-36, keep it up, guys. You're very close to getting to the next page, all right? And then we have accrued expense and accrued revenues. What does that even mean? So some expenses have been accrued, but incurred even though National hasn't yet received a bill or invoice from the supplier. So in other words, you took on a debt even though you didn't get the actual bill yet, right? And then accrued revenues. This is good. You want these, right? You don't want accrued expenses. You don't want debt that's just stacking up and you're just waiting for that debt to come and slap you in the face. You don't need that, all right? We need accrued revenues. And what that means is some revenues have been earned by year, even though National has yet invoiced the customer or received payment. So you already did the work. The only thing now you're waiting for is that check to come in the mail. That's a beautiful feeling. All right. 3-38, the finished financial statement, right? Now, what does that even mean? Well, we have an income statement right here. Their accounting period started from February 1st, 2007, and they ended their accounting period January 31st, 2008. And this is a snapshot of their income for that entire year, right? And so we see the revenues of 128,000 for hauling, 64,000 for excavating, and then they have a total revenue of 192,600. They had expenses. You can't do business without incurring expenses. It just doesn't happen, right? Expenses, operating expense, wages, subcontractors, gas, oil, maintenance, all that totals to 129,300 total. And then we have admin overhead stuff, right? Depreciation. We have bad debt. We have people that didn't pay them, which is bad debt, interest on mortgage, professional fees, all of that. That totals to 162,600 combined with the expenses. But when you're looking at simply overhead like admin, it totals up to 33,300. 33,000 with this amount, you have a total expense of 162,600. And now you're walking away with only $30,000 as net profit because you're basically putting all this work and you got all these expenses eating away at your bottom number, which is your profit. Okay, 3-39, you made it to the second page. Congratulations, meaning you ended the year strong. You're getting ready to open your books or you're getting ready to close your books, right? So let's flip over to 3-40, closing the books. If you want to continue to use the current ledger, he must take the balances of all the revenues and expense accounts and make them zero, right? And then that's basically essentially you closing the books. And then down here, we talked about this already. We go on to the top right on 3-41, opening the books. If Brown wants to use a new ledger, he can leave the old ledger and all its account balances as they are as of January 31st, 2008. He must set up a new ledger so that the assets, liabilities, and equity accounts balances are the same on those old ledgers on January 31st, 2008. This is called opening the book. He does not open revenue and expense accounts with their old balances because he wants them to have a zero balance in his new ledger, okay? So you're opening up a new ledger. And then right here, we have a summary on 3-42. It talks about a summary of financial statements preparation. That's just generally how to know what to do as far as like debit and credits and how to properly allocate their credit and debit balances. But most importantly, we have down here, other types of legal organizations. They'll ask you different questions pertaining to proprietorship, partnership, corporations. And keep in mind, we learned about them in the earlier chapters, but now we're learning about them, how they're applicable to the accounting aspect of this chapter. So other type of legal organization, we're right here, 3-42, right? We flip over. It talks about partnership. Each partner who invests money in a company has an invested capital account in his name. And all that means is Jim Brown invested capital, boom. That's it, right? And then we go over to corporation, which is a little bit different. The only thing you want to make note of is the difference of the name of the equity that's invested. In a partnership, we see that it's invested capital account in his name, which is Jim Brown's invested capital. Of corporations, unlike proprietorship or partnership, is a business that has a legal existence of its own. Saw this question so many times on this test, it's ridiculous. And it states that it has the right to sue and be sued by others. In the corporation structure, you only lose what was invested. And then the equity section of a corporation, this is known as stockholder equity for corporations. So on partnerships, we have what is called the capital account in your name, and corporations, we have stockholders equity. You want to know that. And it says shareholders are a person who bought stock shares of the company, which are certificates that indicate ownership of a part of a company, right? And then we want to know also that within a corporation, there's two forms of stock: preferred stock and there's common stock. Okay, congratulations, you made it to the next page. This information is a lot, but most importantly, like I said, you want to know where the information is found.